Hello and welcome to the Monday Technical Market Outlook for September 21st, 2009. This is Patrick Serezna. As always, we start with a weekly chart of the S&P 500 going back several decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. In January 2008, we crossed below that line, and that's when we began our thesis that we were in a bear market that should last many months, if not more than a year in total duration. Now, 21 months later, we've now actually had our first official test back into this line. Now, that doesn't immediately make it an outright bullish signal, but what it will be very interesting to see is that when we finally do get a good market correction, will it only be just a retracement, and if it is and we find a good basing, when we finally thrust back above this line, it may in fact be a very bullish signal. Now, these bullish signals would mark a multi-year trend and not just a short-term trading opportunity. Next here, I want to take a closer look at that S&P 500 using that SPDR exchange traded fund symbol SPY. Now, we just got above that 104 to 106 focal point and are now thrusting forward like we were anticipating of numerous pushes. That blue line marks the 109 level, which is actually corresponds with a 10,000 Dow. So we're going to be watching that as an interesting level as well. But the 110 to 112 area is numerous measured moves, as well as there's a fib retracement up in there. So at the, we do anticipate that there is a strong potential for a market top to be occurring in here. We're still siding with that at this stage and are still looking for that particular pattern to play out. The one thing we do want to emphasize, there are a lot of people out there talking about a push all the way up to the 1200 level on the S&P, which would be about 120 on the SPDR, right up into this zone over here. We personally do not have the outlook that the market will make it up there, but we can't rule out the possibility that we do have a melt up. If we did actually get a solid market move that pushed above the 110, 112 area and started an aggressive move, at that stage we would target that area where there's another major fib retracement, as well as where the September of 2008 market crash began from. So that is certainly some point of relevance, but at this stage we continue to focus exclusively on this zone where we are at right now and looking for the actual short-term market top to occur right in here. Just to review our key points, our thesis since January 2008 has been that we're in a bear market that should last many months, if not more than a year. Early at the beginning of this year, we were saying that this bear market could end as early as the fall of 2009, but can realistically extend into the 2010 period. Right now, again, we are testing a key level on the upside, and what will actually be far more important is not the fact that we're testing it, but rather as to where the selling will go down to when we correct. If we get nothing but a retracement down over a couple months that finds some very good support levels, and we turn around and start to rally from that, that actually would then probably mark the end of the bear market. If we have a much stronger sell-off that goes all the way back to retest those previous lows, at that stage we're going to probably see the real bottoms come in sometime next year. It'll be very interesting to see how that plays out here. On the very short term, we do not want to stand in the way of the bulls. But we are on the alert for a market top. And again, when we say on the alert of, we're not saying that there will be a market top, but rather numerous measured moves are measuring out into here, and this will be a very natural place for a market top to actually occur. We at this stage feel that the risk reward of being long is very poor at this stage, and therefore starting to raise cash and becoming more conservative with your investment holdings is very prudent. And only short-term actively managed trades are prudent. Long-term investors still need to be cautious and avoid overexposure to the markets. Next here, I want to take a look at the NASDAQ 100 using the exchange traded fund symbol QQQQ. And when we managed to get that rally to hold above that 3940 focal point, we were suggesting that the measured move targeted the 42.5 to 44.5 on the upside. We now officially have started testing that area. And even though, again, there might be another dollar or more on the upside of the Qs, these are levels up here where we're very interested in locking in a lot of these profits on anything that you were long on the NASDAQ. So again, it's not a rush to get out, but certainly at this stage we are now completing the correct measure moves right up into our target zones. Next year, I want to take a look at that U.S. dollar index, and the U.S. dollar continued its decline, and now we've officially have tested that 76 level, which is the top end of our focal point in that 75-76 zone. And as much as the selling has been methodical, there hasn't been a lot of acceleration or nothing dramatic in terms of these drops. At some stage down here, we'd like to think that the U.S. dollar can create some sort of a bottom in here, but the one thing we do want to stress is that the very end of market moves tend to accelerate. So if we do flag in here and go again into that zone, there is quite the possibility that we may even have a slight overshoot of the 75 area on the downside. Nonetheless, if we see a good basing in this zone, this zone right over here would be a logical place for the U.S. dollar index to start bottoming out. If in fact we're destined for a bigger picture move, the downside target is a 72.73 on the downside, but at this stage we want to first observe whether or not the bottom's going to hold in here. Next year, I want to take a look at gold bullion using that Spider Gold Trust exchange traded fund symbol GLD. What we basically now have is testing into what we call our measured move. This is the target area of what we were looking for our upside here. We're already seeing some of the little selling candles coming in here off of this zone. What will be the most important to see at this stage is whether or not selling is contained into a shallow kind of flag formation on the downside. If at this stage this could be one of two things. This could be a top that's coming in here, and we're not ready to call that here. But if we have some nice shallow selling, then that could actually be the springboard, which gold finally makes another big push higher. So we're looking for more information from gold here. But nonetheless, anyone who is long off of our upside breaks, this would be a very prudent swing high to be locking in those profits, and then you could use another roll up in the charts to re-enter the market if it's in fact destined to go up to that 103 to 104 zone. Next, I'd like to look at crude oil using the United States Oil Fund, which is exchange traded fund symbol USO, and more or less we continue to have a sideways triangle style consolidation here as we are testing the upper zones in that 38 to 39 zone on some occasions here. Really at this stage we're waiting for a cue as to whether or not this is a topping formation or whether in fact we have one more break higher. If in fact we're able to get above those previous highs in that focal point around that 38.5 to 39.75 zone, oil can still make one more push. There are some measurements on the upside that target a move as high as the 43 to 45 zone on the upside, but we would first need to have confirmation that in fact oil is ready to make that move, because if in fact we have a US dollar bottom come in here and gold reversing, if that happens, then in fact crude may not make that push. And finally, I wanted to have a quick look at a broader basket of commodities using that PowerShares commodity ETF symbol DBC. Broader baskets of commodities continue to be very range bound. There's no follow through or momentum on either side. If the US dollar does have one or two more dramatic pushes on the downside, at that stage we may see these commodity ETFs test back to their previous highs around that 23 to 24 zone. But in the same respects, if we see that bottoming coming in there, then there's probably little to no upside here. And that was your Monday Market Outlook. Thank you for joining me.